This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Today's discussion delves into the heart of the Federal Reserve System, specifically the powers granted to its individual banks. It's a complex topic, but crucial to understanding the inner workings of our monetary system.
Indeed. Section 13 of the Federal Reserve Act outlines a broad range of authorities, impacting everything from everyday banking transactions to managing national economic stability.
Let's start with the most fundamental, receiving deposits and collections. How does this seemingly simple power contribute to the larger picture?
It's the bedrock of the system. Federal Reserve banks act as central clearinghouses, handling massive volumes of transactions daily, ensuring the smooth flow of funds throughout the financial system. This facilitates efficient payments and reduces risk for individual banks.
And what about the power to discount commercial, agricultural, and industrial paper? This sounds like a key element of monetary policy.
Absolutely. This is where the Fed influences credit availability. By discounting eligible paper, essentially lending money to banks, the Fed can increase or decrease the money supply, impacting interest rates and overall economic activity. It's a powerful tool for managing inflation and stimulating growth.
The Act mentions specific criteria for eligible paper. What are some of the key considerations?
The eligibility criteria are designed to ensure the loans support productive economic activity, not speculative investments. The focus is on short-term, self-liquidating loans tied to real commercial transactions, excluding things like stock market investments.
Section 13 also addresses the discounting of paper for individuals, partnerships, and corporations under unusual circumstances. This seems to be a more recent addition reflecting changes in the financial landscape.
Correct. This provision allows the Fed to act as a lender of last resort during financial crises, providing liquidity to prevent systemic failures. However, it's subject to strict oversight and requires the approval of the Board of Governors and the Secretary of the Treasury. The emphasis is on broad-based eligibility and preventing bailouts of individual failing firms.
Let's move on to the discount or purchase of sight drafts. How does this function differ from other lending activities?
Sight drafts, often secured by bills of lading, are tied to the shipment of goods. This is a specialized form of financing for international and domestic trade, facilitating the movement of commodities and supporting businesses involved in import-export activities.
The Act also places limitations on the amount of paper a single borrower can have discounted. Why is this important?
These limits prevent excessive concentration of risk within the system. By diversifying lending across multiple borrowers, the Fed mitigates the potential impact of a single borrower defaulting. It's a crucial risk management measure.
The section details the discounting of acceptances, a crucial aspect of international trade finance. Can you elaborate?
Acceptances are essentially guarantees by banks for commercial transactions. The Fed's ability to discount these acceptances provides additional liquidity to banks involved in international trade, facilitating global commerce.
The Act also grants Federal Reserve banks the power to make advances to member banks on promissory notes. What's the purpose of this?
These advances provide short-term liquidity to member banks, helping them manage their daily cash flow needs. The collateral requirements ensure the safety and soundness of these loans. The Fed can also use this power to influence the overall level of credit in the banking system.
The Board of Governors plays a significant role in regulating the activities outlined in Section 13. How does this oversight function?
The board sets the rules and regulations governing discounts, purchases, sales, and advances. This ensures consistency across the Federal Reserve System and prevents individual banks from engaging in risky or inappropriate lending practices. It's a crucial element of maintaining financial stability.
Section 13 also touches upon the activities of national banks as insurance agents or real estate loan brokers and the creation of dollar exchange. How do these relate to the broader powers of the Federal Reserve banks?
These provisions reflect the historical evolution of the Federal Reserve's role. While not directly core to monetary policy, they illustrate the system's broader influence on the financial landscape. The ability to facilitate dollar exchange, for example, supports international trade and the stability of the U.S. dollar.
The section concludes with provisions related to transactions between Federal Reserve banks and foreign bank branches and agencies. What's the significance of this?
This reflects the increasing globalization of finance. It allows the Fed to extend its services and regulatory oversight to foreign banks operating within the U.S., promoting stability and fair competition in the international financial market.
So, in summary, Section 13 grants Federal Reserve banks a wide array of powers, all designed to promote a stable and efficient financial system. These powers, while seemingly disparate, are interconnected and work together to achieve the Fed's broader monetary policy goals.
Precisely. The section's provisions are not isolated, but rather integral parts of a complex system designed to manage credit, liquidity, and overall economic stability. The careful balance between these powers and the regulatory oversight is crucial for the health of the U.S. economy.
That was a great discussion. Thank you for your insights.